Can we breathe a sigh of relief now in terms of the supply side at least?
Well, I think the cuts that have been announced, if there's adherence to those cuts, and we also have additional cuts in production that come from non-OPEC that was not included in the OPEC Plus deal, it does reduce the risk of a further price collapse in Brent crude oil prices and reduces the possibility of it dropping below $20. But it's still going to be some difficult times for the oil market as we go forward, just because of the slowdown in demand, and so it take a while for that demand to come back.
What are the implications for US shale then? Because, going into these talks, a lot of investors were essentially saying there's not much point in these expectations from OPEC when the US won't cut.
Well, we think that shale production will have to be reduced just because just to face the fact there's not the demand there. You've already seen U.S. refining utilization reduce significantly in response to the slowdown in demand. We've seen crude exports drop that are coming out of the U.S. And at these prices, the shale producer will have to reduce production. And we expect further production cuts to happen. In the rest of 2020, we see production dropping down to around 11 million barrels per day for the U.S., and then further cuts all the way through the next year down below 10 million barrels per day. So when you look at that together, those 2 years, we see cuts around 3 million barrels coming out of the U.S. And we think that's what's required for the market to balance, and we think that's what it will take in terms of getting prices back to more normal levels at some time.
Taking into account U.S. production as well as refining, where do we see WTI and Brent differentials going from here?
Well, in the short term, we see as we move in with this deal, and if we have further cuts in production, and on the expectation that the U.S. economy will slowly start to open sometime in early May, then we expect demand to start to pick up, refining utilization to pick up a little bit. And with the cut in production, we start to see that WTI Brent will narrow a little bit over this time frame. And then as we go into the end of the year, we see that start to widen a little bit again, closer to $8. And then as we go in through 2021, we expect it to stay around that time, that level through the rest of the year. And we think that differential is going to be required because it's going to take that incentive to keep putting pressure on U.S. producers to reduce production.
So when we're talking about global demand, what are your estimates for global demand loss given the coronavirus outbreak this year? And in what fuels will you see the biggest impact, whether it's gasoline, diesel, or jet fuel?
Well, for all of 2020, we see demand dropping by around 8.5 million barrels per day. So when you look at 2020 in comparison to 2019, we see a drop of 8.5 million barrels. A lot of that is going to come from gasoline, and a lot of that, of course, is associated with the U.S., which is the largest gasoline market. Also, a lot of the miles driven in terms of gasoline is discretionary, and with the slowdown in the economy and the social distancing, and that not coming back for a while, we expect a significant amount of that demand coming out of gasoline. Of course, jet fuel is another area that has been significantly impacted, not by the slowdown in the economy, but just the stoppage in flying. So that'll be another. And then diesel fuel will also drop, but not to the same extent. So if we're looking at order, it's going to be gasoline, then jet fuel, and then diesel in terms of percentage drop over the next year and a half.
John, how much does a quicker than expected recovery in China really kind of, I guess, change your outlook? And does it, in fact, change your outlook on the demand side?
Well, I would say with what's happened in terms of the supply cuts and what we're starting to see better news coming out of both here in the U.S. and what we're starting to see in Europe, and then also the return in China, we have increased our outlook for crude oil prices. We saw crude oil prices dip significantly and down to Brent, I think, dropped down to around $22 and something several weeks ago. We've now seen that improved, but that will help. That coming back has helped. So we have increased our outlook for crude prices somewhat, but we still see that crude prices will struggle to break above $40 and stay there through May of 2021. So it's just going to take time for supply demand to rebalance again and for to get past this huge surplus of supply and inventory that's being built up.
Given that U.S. stockpiles remain still so elevated, how much, I guess, relief do you think this deal will actually create? And does that give really that much of an expectation of relief within the energy sector in terms of these concerns that we're going to see mounting bankruptcies?
I think it helps stabilize it somewhat. It's certainly not going to take away the reality that we've had this significant drop in demand. And a lot of that drop in demand is going to impact the outlook for prices and then what it means from a financial standpoint for the shale players. They are going to have to reduce production. That is just a fact that is going to because there's just not going to be the demand or the market for that crude, and also financially they're doing very poorly at this time. There's going to be more bankruptcies. And so it's just a fact that the shale industry is going to continue to feel pain. And that's what it's just going to take, though, to get through the next 18 months.